Once again, thank you all so much for joining today's webinar. It's going to be a very simple but a practical sort of discussion that we're going to have. Feel free to put all your questions in the Q&A section or the chat box. I'll take it towards the end of the webinar. I'm sure this title itself is very self-explanatory, right? Is your portfolio built right? And this is a question that you may be asking yourself, or a lot of investors have been asking us also. Am I audible? Is the audio clear enough? Is it loud enough? Great, sir. Then maybe you may want to check your audio system in the device that you're using, sir, because everybody else is able to hear me very clearly. So a very important question, is your portfolio built right? Because most often investors or even the general public, they all look at the headlines and they see markets touching new highs. And they, of course, they assume that, even their personal portfolio must be doing very well. But that's not always true in reality, because a rising market necessarily does not automatically mean that it's a well-built portfolios, right? Many portfolios, they appear active, they appear diversified, and long-term investing strategy, etc. But when you look deeper, there may still be some level of inefficiency or not enough alignment. It may be exposed to some risks, or rather unnecessary risks, if I may put it that way, right? And this is that gap that we want to address today. And this session, please note, it's not about chasing the next winner or predicting the market. It's about understanding whether your portfolio has the right structure, it has the right purpose, and it's following this right kind of discipline, right? So I want all of you that are here with me in the webinar to ask each one of yourselves one very important question. If the markets rise, does my portfolio rise for the right reasons? Or is it simply moving randomly without a strategy? Because honestly, a portfolio should not be just a collection of products, right? It should be a carefully curated and designed financial plan, which is going to help you move forward, achieve your goals, and build wealth for the long term, right? So over the next 1 hour or so, we'll try and break all of this down in a very, very simple way using practical examples. And we will look at some of the mistakes that we have seen investors make, try and address that, some of the hidden portfolio mistakes, reasons why some portfolios underperform, that sort of gets buried, the role of behavior and the role of mind in investing, and most importantly, some of the practical checkpoints that you as an investor can use to help you build a stronger portfolio. So the aim with which I am communicating or hosting this webinar for all of you is that I want all of you to walk away with some level of clarity, right? No confusion, no jargon, but just clarity, right? I'm so sorry, there seems to be some issue with my video. I may keep going on and off, please don't mind that, but I will continue as it is. So let me start with a real life examples, a real portfolio story, right? It's a portfolio that we reviewed very recently within the team. So this portfolio was roughly worth about 2 crores, and on the surface, it looked quite good, right? There were multiple funds, there was meaningful amount of capital that was being allocated, and the investor was under the impression that he or she was reasonably diversified. But when we reviewed it, 3 major reasons and issues stood out. The first one was, and this we see across reviews, it is not just subject to this one portfolio, but we wanted to address this because it's a larger portfolio and how this can affect wealth creation from here on. But this is something that we see quite commonly. First issue was that there were way too many similar funds. And this is more common than people think or assume, right? Investors very often assume that having more funds means being more diversified, but that's actually not the case. But if several funds own the same type of companies, follow similar strategies, or there is a significant overlap. In mutual fund investing, I know you cannot avoid overlap, but you can avoid significant overlapping, and then what looks diversified actually ends up being duplication, right? The second issue was poor asset allocation. All of the money was invested, but it was not allocated with intention. There was no clear balance between growth, stability, liquidity, and protection. So the investor had exposure, but not the structure, not the right structure. So that makes the portfolio vulnerable, especially during certain market conditions. I see there's a question in the chat box. Feel free to put all your questions in the Q&A section of the chat box. I will take it towards the end of the webinar. And the third and the most striking issue was that there were no clear goals, right? Investments had been made over time. He had been invested for a very long time, but without linking them to certain goals, for example, say retirement or your child's education or any future purchase like a home or a car, it could be anything, or any defined financial outcome, right? So the portfolio existed, it was there, but it had no destination. So there was money, but there was no intention. You know, that's the kind of attitude that we got out of this portfolio. And this is exactly why portfolio reviews even matter. We do not expect all our leads or clients to be aware of what the markets are or be very, very well informed about it. There are people who need the guidance, and that's exactly why we're here, right? Which is why I'm of the firm belief that portfolio reviews are extremely important. And the problem is not always that investors are doing nothing. In fact, many of you are doing quite a lot, right? The problem is that activity is often mistaken for strategy, which is not the case. So owning products is not the same as building a portfolio, right? A good portfolio must answer three questions. Why am I investing? How am I allocating? And what role does each investment play? We are going to look at this in a much deeper sense later in this webinar. So this real story is not a very unusual one. It may sound very familiar to a lot of you. Listening. Which brings me to some of the hidden mistakes that quietly damage portfolios over time, right? And these are not dramatic mistakes. They're very subtle, they're very common, and often ignored until they realize that performance is what is disappointing, and then they come to realize that they need to make changes in their portfolio, right? So this slide basically highlights three of those hidden mistakes. Again, we come back to no clear goals, poor asset allocation, and chasing past performance. Let's start with the first one, no clear goals, right? If you invest with a target, without a time horizon, and with unrealistic return expectations, then your portfolio does not have a real anchor. What is it doing? And what is it going to do for you? What do you want it to do for you? There is no anchor for it to hold on to and do its work from there. You may be saving, but you're not planning, right? And when the markets become volatile, investors without clear goals, they tend to panic much faster because they don't have anything stable to fall back on, right? And that leads them to make some harsh decisions which they may not, or which they may regret going forward, right? The second mistake is poor asset allocation. Many portfolios become very over-concentrated in just one asset class, right? Or they probably ignore the investors or their own true risk potential, or they operate without any rebalancing, etc. So asset allocation it's not a technical detail per se. It's actually one of the biggest drivers of a portfolio behavior, right? A portfolio that is misallocated may do well very briefly for you, but it rarely does well consistently and in the long term, which is exactly why we all invest, right? And the whole purpose is not served when we do poor asset allocation and misallocation of capital, because we are dealing with money here. Whether it's 10,000, whether it's 1 lakh or 1 crore, we are still dealing with our hard earned money. So imagine going through or running the risk of misallocation of capital and also not reaping the benefits of investment, right? And the third mistake, and something that I think if all of us must have done at some point in our life, right? Chasing past performance. This is where investors buy what did well last year, assuming recent winners will continue the trend, right? But investing looking at the rearview mirror is often very, very dangerous, right? But because by the time a fund becomes popular, a lot of the easy money may already have been made for you. But that's where the recency bias comes in and it enters the decision-making process, right? You end up missing future opportunities. You're still harping on the fact that this may just end up doing well for you, but there's a good chance it may not. And you may be letting go of some other amazing opportunities that are in the market, right? That could have even done better for your investments. So the simple fix here that's also mentioned at the bottom of the slide is set SMART goals, right? You all may have heard of SMART goals. You define your asset mix, you stick to a plan instead of trends, make it measurable. There should be a target, right? It should be relevant for the stage of life that you're in also, right? So in investing, of course, always clarity beats the excitement, and structure beats noise, and process beats prediction. That's what you have to be gunning at, right? So if anyone here is reviewing their own investments after today, start by checking these 3 areas first. They may reveal more than what your statements may. You may end up realizing a lot more than what you actually end up seeing. So this brings me to behavioral biases. One of the most underestimated risks in investing is behavioral bias, and it's actually not even the market risk. Portfolios, most often than not, are not damaged by lack of intelligence, but are damaged by emotional decision making, right? Because fear shows up when markets fall and investors sell at low. What was once a temporary decline becomes a permanent loss of capital because the investor exits at exactly the wrong time, right? Because there is some amount of fear. Instead of responding to a plan that he or she has set for himself, they respond to the discomfort. And that's extremely dangerous because investing always tests your emotional endurance and resilience. Now, after fear comes greed. So the greed pushes all investors to hot funds and funds that are doing extremely well, momentum plays and all of that, recent winners and stories that seem almost impossible to ignore. After a sharp rally, many investors may feel like they're missing out. So they enter late and they go in with such unrealistic expectations and very little margin of safety. And this is how people end up buying high, not because the asset is right, but because the momentum is tempting and they end up falling into that trap. And then, of course, there's noise. We live in a world where we're surrounded by all kinds of noise, right? It's inevitable. And I think it's the most constant distraction of all time. Headlines, tips, you have social media opinions, you have the news, you have TV experts, you have WhatsApp forwards, right? And all of this creates urgency without creating wisdom. They may not necessarily be creating wisdom by sending or saying these kind of things. So when investors react to this kind of noise, they abandon their own strategy that they've set because they think the broader headlines in the broader market is what is defining what they're doing. But it's the noise. You need to learn what to keep and what to shut out, right? They become very busy in sort of trying to align it with what the headline says. And in the process, they just end up building a portfolio that may not do well for them in the future, and then they will regret it again. right? So it's not the most effective way of building a portfolio. And what all of us also need to realize is that a strong portfolio is built not just with good products, right? It's built with great behavior, great resilience, great endurance. That means knowing when not to act, right? When not to panic sell or panic buy, when to stay disciplined, and when to revisit your financial plan instead of reacting emotionally. In most cases, actually, the difference between successful investing and unsuccessful investing is not what you bought, right? It's how you behaved after you bought it. That's what tests a real investor's mark. So when we speak about portfolio construction, we should also speak about investment behavior, right? Because even the best portfolio can be ruined by poor decisions. You may be the best of investors, but you may not have made the best decisions. And an average portfolio can improve meaningfully with disciplined behavior, which is where we have to realize that time in the market is greater, much, much greater than timing the market. Right? This is another major destroyer of wealth creation, which is trying to time the market. Right? So the first red flag that we see is that investing at market highs, right? This, again, it usually happens because of FOMO, the fear of missing out, as we all know. Investors, they look at the market rise, they hear a lot of success stories and feel the pressure to participate almost immediately. But when the decisions are made at peaks without any proper planning, the downside risk becomes much higher for you. And the investor is not entering with a strategy. They're entering with the urgency that, you know what, if I don't do it now, I'll miss it, but not realizing what it may cost them in the future. Second is that you're exiting during corrections because of the imperative need that everybody finds to time the market. This is where panic does real damage. Corrections, I understand that corrections are uncomfortable for some of us, but it's normal, right? Yet, many investors, they sell precisely when prices become more reasonable. When they should be buying more is when they're all selling. And the irony is that the recoveries often begin when the confidence comes back, right? So some of the strongest rebound days, it comes very early, and the investors who exit in panic often miss them. I can give you a real life example. I was talking to my uncle about this the other day. He lives in the US. He's based out of San Diego. And I will not name the stock or give you specific details, but I'll tell you the mindset that he was in. He had bought a stock at around $120, and he sold it at around 320, which is today at around $950. So he just thought, you know what, I don't think it's going to go up beyond this, and he could have accumulated more at that point. But he said, I was too scared to be invested and I wanted to sell out of it. This is the real mindset of all investors. There's nothing wrong about it, but this is how our minds work when we're dealing with money. And which is why we all need advisors who will help us through these kind of situations. He was doing it by himself, right? And we all know how the geopolitical situation is in the US. And I was telling him about how I'm doing a webinar like this tomorrow, and he should really attend it. So just look at where 320 is and where 950 is today. He would have easily made about 10 times the money that he had invested if he had stayed invested and not panic sold at that moment, right? Third is you stop SIP during the downturns. This may feel safe initially and emotionally feel safe, but financially it can be a mistake, right? Downturns are often the best time for you to, value your SIPs even more, because It allows all of us to accumulate units at lower prices, which is what we call the rupee cost averaging process. So if you stop SIPs at that stage and at that point, you are stepping away from one of the most powerful parts of disciplined investing, which is A, rupee cost averaging, and B, you're also missing out on the compounding. So the broader and the deeper lesson here is quite simple. Trying to time the market may sound smart, but for most investors, it becomes a very emotionally driven and inconsistent decision. So time in the market combined with some discipline and proper asset allocation, time in the market, not timing the market. Time in the market plus discipline plus proper asset allocation is usually far, far more reliable than trying to outguess and outsmart short-term market moves, right? So the goal is not to predict every turn. The goal is to build a portfolio that can live through each of these turns. So now, what makes a good portfolio? So if whatever we've seen so far, if these are common mistakes, what actually makes a good portfolio, right? That's what we're going to talk about in this slide. First, and again, I think this is the third or fourth time we're coming back to the same point. Let's start with clear goals. That's I think very, very important. It's the most primary and basic thing that everybody needs to assign to their investments. There is meaning and outcome only when it is mapped to something, whether it is your career plan, whether it is your financial plan, right? It could be retirement, it could be your child's education, marriage, house purchase, or just wealth creation also. What happens is when you map it to a goal, you give it direction, right? And once you know the purpose, the investment process and the structure becomes much easier. You know the road that you're traveling and the road that you're treading, and you know what your final destination looks like, right? Then comes periodic reviews, right? Of course, it's not a building a portfolio is not a one-time event. It's a living structure. It's a living process. Markets will change. Personal situations may change. Your behavior as an investor may change. The risk capacity also changes. Goals may also evolve, right? Maybe my goal here at 25 might be something else, but 10 years down the line, my goals may be different. So it is important that you review your portfolios regularly, not just to see which part of the market is doing well, but also to evaluate what is not doing well for you and exiting out of those ideas, creating liquidity. That way you're able to invest in better ideas, right? And the third one is proper asset allocation. This is what builds the architecture of the portfolio. It decides how much goes into each asset class, how much into equity, debt, precious metals, global, depending on the market situations, right? And the point is that a good allocation, it reflects not only market opportunities, but also the investor's temperament, behavior, and the time horizon for which he or she is willing to stay invested. Fourth one is, of course, discipline and disciplined execution. Good investing it's not just about knowing what to do, but it's about doing it consistently. That means that you're avoiding your emotional reactions, your FOMO, your panic selling, panic buying, and all that. And you're sticking to the plan that you made for yourself, you charted out for yourself, and you make decisions based on the process rather than noise. You filter out the noise. And finally, appropriate diversification. This is also very important. It goes hand in hand with the asset allocation. It's not just about random diversifying and just randomly putting products and mutual funds in the portfolio, and not excessive product accumulation, but it's about diversifying thoughtfully. And every investment should serve a role, should serve a purpose. And once these 5 elements come together, is when the portfolio becomes much stronger, much more well-rounded, more resilient, and far more aligned with what the investor actually needs. Right? So these are some of the things that you have to answer, right? Which is the first part of the question in the webinar's title. Is your portfolio built right? These are some of the aspects that you have to keep in mind. The 3 practical reviews or the 3 practical ways that you can do it is going to be the second part of this presentation, right? So to basically simplify everything we've discussed so far, I want to bring it down to 3 practical reviews that you can use, right? Even if you don't remember anything else that we spoke about in today's webinar, just remember these 3: goal alignment, asset allocation, and diversification check. This is practical not because they are theoretical concepts. It's a lens of review. They help you assess whether your portfolio is actually working for you. So the first question should be, does my portfolio match my goals? The second is, does my asset allocation reflect my risk profile and my time horizon? And third, am I genuinely diversified, or have I just accumulated multiple overlapping products? Right? So most of these portfolio issues can be tracked and traced back to weakness in one of these 3 areas for sure. So if goals are unclear, investments become random. If asset allocation is poor, then your risk and horizon becomes distorted. If diversification is misunderstood as a concept itself, then complexity in the portfolio also increases, and that does not help in receiving the outcomes that you may want, right? So the beauty of this framework is that it's simple for absolutely anybody to understand. Just 3 things you need to remember: goal alignment, asset allocation, and diversification check. But even though everybody can understand it, it is also powerful enough to reveal things in a more deeper sense. You need not be an expert to ask yourself any of these questions, right? You only need to be honest and have a structure to be able to even ask yourself these questions in the first place. Right? Let's go one by one. Let's begin with the first one, which is goal alignment. This may sound very basic, and it is basic, but it's a very, very powerful tool for every investor, right? Every rupee in your portfolio should have a role. If you have been watching our social media channels, if you've been watching videos of Shyam Sir, this is something that he emphasizes everywhere. Every rupee in your portfolio should be marked to a goal, right? When investments are linked to specific goals, decision making also becomes much easier, right? Yeah, sorry. Like I said, when investments are linked to specific goals, even decision making becomes much easier. For example, the money that's meant for retirement in your life should not be treated the same way as the money that you need for maybe buying a home. Similarly, education planning, family planning, emergency reserves, and all of that. Emergency reserve, very important. First build that and then build the rest. So without goal alignment, portfolios become just a random mix of scattered products. Investors even end up forgetting why they bought something, how long they intend to hold it, and what success should even look like in this portfolio, right? So, and that is exactly when short-term market movement starts dominating decisions. When you forget the purpose of why you're even investing in the first place, you will fall into the trap of reacting to noise, making emotionally rather incorrect decisions, etc. But when you link each investment to a goal, the portfolio becomes more purposeful. It serves a certain purpose. You stop asking what is the hottest fund right now, and you start asking what is the right vehicle to achieve this goal and to achieve this objective. And that's far more mature and effective in the investment world than anything else. So a simple exercise for all of you today: list your major financial goals on a sheet of paper or your iPad or your laptop. Assign a time horizon to each of it, and then map your current investments against that. And if you don't, we are here to help you. You can feel free to reach out to us and we'll help you. Second, again, very important, asset allocation, which is the foundation of every portfolio's design. You see the major buckets. There's equity, debt, precious metals, global. You may want to hold some in cash, right? The most important question that you should be asking yourself here is, does your allocation match the kind of investor that you are? This may change. Maybe when you're 20, it's different. 35 or 40, it's different. When you're 60, it's different. And it's a very critical question because many investors have portfolios that reflect market excitement and not personal suitability. They may say that they're conservative, but hold a lot of aggressive allocations, right? Or they may have long-term goals, but keep too much money in growth assets. Equity is usually a growth engine. And in this market, I think everybody should be taking advantage of the equity markets. Debt can provide stability and predictability. We had a period when we were aggressively pushing for debt. Now we're also looking at a strategy that can be a good FD replacement for all investors, right? And then you, of course, have precious metals that can be a hedge, global investments, and cash to have some level of liquidity and flexibility. None of these, I'm not saying any of these are good or bad in isolation, right? Their value just depends on the proportion and the purpose and what market situation that you're in. You should be willing to rebalance. And a well-built portfolio never asks which asset class is the best. It always asks what combination is right for me or right for the investor, and maybe the goals also, right? And that's exactly why it brings me back to the same point. Rebalancing matters, right? Over time, market movement can distort your allocation. Equity may become too dominant after a rally, or there may be too much cash after being hesitant to invest. So rebalancing brings the portfolio back to the intended design. It is possible that you may lose your way in the middle, but your advisors will bring you back to where you are. We will help you do that. And if you're managing it on your own, you should always go back maybe once in 3 months, once in 6 months, and rebalance your portfolio. That's the act of discipline. And next is appropriate diversification. Are you diversified or are you just duplicated? Right? The real question is, how many funds do you hold? That's not the real question. The real question is, why do you hold each one of it? Right? If there's no clear answer, then the portfolio may be optically diversified, but it's duplicated in its substance. Right? Different funds may hold the same stocks. Again, like I said, in mutual fund investing, or even PMS investing for that matter, overlap is inevitable. You may have certain similar holdings, but what is the difference in the outcome that's being delivered? Because owning more funds only creates complexity without adding any sort of value. It becomes harder to monitor, harder to review, harder to even understand what is driving performance in the first place, right? So in many cases, investors just end up with overlap across large caps, flexi caps, without realizing how similar the underlying exposures are. That's why having a simple portfolio is very powerful. Clean portfolio is never a weak portfolio. That's the mindset people need to get out of. In fact, it's often much stronger because every holding has to justify and claim its presence, right? And place in the portfolio. And here again, rebalancing matters because over time, additions that are made into the portfolio can casually turn into a very, very cluttered one. So this, make sure you tick the boxes in this checklist, right? Every strong portfolio or every portfolio should pass these 4 basic things in the checklist. Make sure every investment or every rupee has a purpose. Ensure your allocation matches all your goals. Ensure that the diversification is appropriate and the portfolio is reviewed periodically, right? And this checklist is powerful. Why? Because it converts good investing into something practical. It converts good investing into disciplined investing. Instead of getting lost in market noise, product names, or return comparisons, you come back to the fundamentals. Does the investment belong here? Does my allocation still reflect my needs? Am I actually diversified? Right? If the answer to all of these questions is a yes, your portfolio is probably on a much stronger footing than any other portfolio. And if the answer is no, it's not a reason for panic. There's always scope for improvement. And I would encourage everybody in this webinar today to use this checklist, right? Sit with your investments, sit with your advisor, evaluate it, identify your blind spots, and then you'll be on the path to creating long-term wealth creation. Now, that brings me to how we help you in building portfolios. Our role is not just to recommend products. Our role is also to help investors build portfolios with structure, suitability, and discipline. Right? We provide periodic rebalancing, periodic reviews, etc. And with respect to a structured portfolio design, it means that we start with the investor, not with the product. We look at their goals, their time horizon, risk profile, and their overall financial context before we design the portfolio. This basically, it helps ensure that the portfolio is built around the person and not the market. Behavior and decision, of course, that support is equally important, because even a well-designed portfolio needs good decision making through market cycles. We help our investors try and stay grounded, avoid any reactive mistakes, and remain connected to their long-term plan. And then comes fund selection and simplification. This is about reducing the clutter and improving purpose. We here at ithought are of the belief that portfolio should be understandable and not overwhelming at any point. The right selection process is not just about adding more, right? It's about adding with intention and removing maybe what does not serve a clear role. Right? And finally, review and rebalancing, it ensures the portfolio remains alive and aligned to every part of your investing journey. So we revisit, we refine, we rebalance wherever we need to, so the portfolio does not drift away from its objective, right? And that is exactly how long-term portfolio management should work. And that's exactly where we come in. It's not a one-time activity. It's an iterative process. It's an ongoing disciplined process with all our investors and leads. That brings me to the end of the presentation. Feel free to ask any questions that you may have. This is our contact. If you would like a review of your portfolio, or if you would like to speak about your investments or have any questions, you can always get in touch with us at 9500027285. You can visit our website and understand what services we provide. And we'll be very happy to speak to each one of you and try and understand what you would like to do with your investments. And we'll be very happy to help you build your investments, right? Now I'll open the floor for Q&A. I'll just give it a few more minutes for more questions to come in, and then just a couple of minutes.